Welcome back to another market closing live stream, folks. Will today the S&P 500 dip into the close like it has 4 out of 5 days last week? Remember, 4 out of 5 days last week. We had closing dips as low as the lows in the prior portion of the day. Now, we've been pretty much trading along the floor here on the S&P 500 along with a lot of other stocks. So it'll be interesting to see, will the lows today actually be low lows of the day? Because remember, previously, what we've seen last week is that we would have a low, let's say around that 9 to 11 o'clock hour, in that sort of range. And then we would go up from there only to come down and crash down essentially at the close. Will that same thing happen today? Except since we're basically trading along the floor here, will we see the S&P 500 trade even lower than the previous lows of the day, thanks to the fact that you get weenie babies who sell their stocks on red days because they see things like ARK down 4%, and ARK needs to get that money back to people. And so we end up seeing sell-offs in the stocks within that particular fund. Given that ARK is falling into the close here, might actually accelerate some of those sell or put some more sell pressure on ARK funds here as the day closes. So we'll see. Usually it's the last 12-ish minutes. That's what we've seen in the last few days. It's about the last 12 minutes. Let's go ahead and see. Let's go back a little bit. We'll look at the 1 minute chart here. Let's see when we can see the fall in prior days. So here we go. It looks like the fall here really began in the last about 15 minutes, really took off in about the last 12 minutes on this was Thursday. This here is this was Friday, but Friday was not one of the 4 days. So last about 15 minutes on Thursday, last really actually more, almost the last 25 to 30 minutes on Wednesday. Last let's see here, last 16 minutes on Tuesday, and on Monday we also had the sell-off in about the last 17 minutes. Okay, good. So in about 4 or 5 minutes, if the pattern holds true, we should start seeing the S&P 500. Oh, this is ARK. My bad. I'm looking at ARK. They followed a similar pattern nonetheless, but duh. If we're talking about the S&P 500, we should be looking at the S&P 500. My bad. And even on Friday, even though Friday ended up much higher and Friday was not inclusive of this, we still had a sell-off within the last about 40 minutes on the S&P 500 on Friday. There we go. Okay, these are the 4 days that I was talking about. Okay, last about 22 minutes on Thursday. Last inflection point, also about 22 minutes. That's about right now. Last about 15 minutes with the first dip around 40 minutes for Tuesday. And then Monday's was last 13 minutes. Sudden acceleration here. So it'll be interesting. Very, very interesting. We will see now. Will we get an accelerated sell-off into the close here as people bail out of funds? My guess is yes. And so we'll see. I'm excited for this. I've raised a little bit of cash, sent over some money. Also did some investing today. Options and investing. Remember, you get all my buy-sell alerts in that Stocks and Psychology Money program link down below. But folks, let's see what happens here. In the meantime, let's do a little bit of an overview of what the heck is happening, because there's a lot. Specifically, the Nasdaq's getting battered the most of Nasdaq Technologies here, but let's take a peek here. So we got the Dow Jones Industrial down 1.04%, S&P 500 down 1.46%, the Nasdaq down almost 2.5%. Sitting at 2.41%, Russell 2000 down 1.18%, volatility index up to 12.2, not as high as what we saw earlier at about 14, but still elevated here. Moving along, we are going to be watching the S&P 500 into the close here today. We're expecting a fall. We're about 19 minutes away from the close, and we've seen various sell-offs begin between 22 minutes and about 12 minutes. So in this next 10-minute period here, will we see the start to an inflection point to the downside or not? If we do, if, for example, let's draw a line here. if we saw a line like if we broke the 126.5 line, which I got to remember to delete this line after I draw it here. But if we break this line, the 126.5 here, and we go below this, we might have an opportunity to go shopping again. I don't mind doing that because we've already been doing that today. So I'm just going to draw it purple here as sort of a temporary reminder that I'm going to be getting rid of this line here. So we're going to keep an eye on this. So far right now, we're not seeing any kind of real directional movement. Lines obviously going up and down here. Classic vol. Nothing special here. So we'll let this bake a little bit, stew a little bit. Got to cook those tendies a little bit, or hopefully not, over or undercook them. But anyway, worth noting that Bitcoin's actually up 49,200. Bitcoin's actually having a good day. Crypto in general having a good day. Ethereum's up 2%. ADA's up 1.5%. That's not bad. You do have Tesla that was up as high as 4%, but thanks to the technology sell-off, we definitely had some profit taking over in Tesla. We went from 4% up to up only 0.75%. We're about 0.75%. Hut 8 mining back to $9.58. You've got Affirm sitting at 107. Owlet sitting at 412. EXPI sitting at 37.59. Enphase 145. And we have Very Good Foods up 7% here. You have Gap, GM, Cardano, Planet, Tesla. Cloudflare pretty much flat here. Macy's pretty much flat. Nordstrom relatively flat as well. It's really the big losers being over here. Looks like more recent IPOs, more recent momentum movers up here, a lot of them. But even things like Redfin, Enphase, Solar Edge, Pinterest, Twitter, Trade Desk rather, Peloton almost under $80 a share here. These folks just getting ripped on today. So, all right, let's see how that S&P 500 is behaving. Again, we've got 15 minutes to the close. It's actually going up right now. So that is a reversal of expectations. And we're seeing what we're looking for is volume to go up. So volume's going up and pricing's going up. That's a sign that the potentially the institutions, rather than selling, are actually buying the dip, which would be very good because that's what we've been doing. Now it would mean less of a buy the dip opportunity going into the close, but that's okay. You don't really want to have a dip every single day because then that means you're going straight down. So good news for those who have already bought the dip. If we end up getting a volume pushing us into a rally into the close, that'll be very interesting. Can we break above 230? My expectation is still that we're going to have a sell-off here in the last 15 minutes, unless, of course, we do see the buy the dipping come out of the institutions and the funds. Entirely possible. So we'll see what happens. All right. So let's see what things we've got here. We have Bloomberg. Biden. We talked about this, blaming McConnell. Made a video about this. Encourage you to watch that if you have not yet. Bloomberg Commodity Spot Index rises to a record. Notification banner just came across. That's not going to be good for those inflation fears. Yeah, Facebook's still down. And Mark Zuckerberg loses $7 billion in hours as Facebook plunges, it says. Plunges. Yeah. Okay. Bitcoin eyes $50,000 for the first time since the El Salvador rollout. Many Tesla short sellers are giving up. Yeah, good. Get out. It's true. The short interest in Tesla has been plummeting. It just has not been a very profitable trade for folks. Sorry, Michael Burry. Not right about Tesla. Well, that's why I sent him an eggplant. All right. So, yeah, golly, let's see if we can get some news here at least. Give us something here in the meantime while we wait to see what happened. All right. Tech stocks enter correction territory as market tumbles. The NASDAQ has fallen more than 7% from its record high on September 7th. Perfect. Good. Finally, a dip of over 5%. But I don't. Has the S&P 500 sold off more than 5% yet? Because we have not had a 5% sell off since last December. Let's go here. 1 month, 6 months. Okay, here. So if we go to the high of September 3rd, oh, we're down 5.15%. We have finally had a 5% sell off in the market. Thank goodness. Been waiting for this. Oh. Yeah, a lot of folks talking about Facebook. Facebook never been really a company that I've cared much about. I just don't like Facebook, so I've never invested in Facebook. It's just a personal problem. It is down 15% since September 7th. Now, in fairness, the FANGs have really been selling off since the beginning of the month. Apple down about 11.38% from its high, and Google also selling down. Google here, Google down. Let's see, this looks about peakish here, about 8.23%. Google almost hit $2,600 today, getting a little under pressure there. All right, so let's see here. High frequency data shows U.S. steadying. Oh, that's interesting. Let's see what we got here. Take a peek at this story here. Love looking at the data. So, just take me a second to pull it up here. In the meantime, I may as well keep the SPY up in the background. Okay, SPY's still stable. Yeah, I have not seen that big volume push yet. We're at that 12-minute mark now. So let's see, are we going to get the big volume, or is that pattern over? It is possible that that pattern is over. But yeah, we're still trending up right now. So we'll see. Pattern could be breaking. Okay, so high frequency data. Here we go. What does it say? Recovery Oh, that's okay. Well, that's I want the US. Here we go. Okay, here we go. As new infection rates abate, spending on in-person services has shown signs of improvement according to US high frequency data trackers. But consumer sentiment has deteriorated over the past 4 weeks, especially for the unemployed after augmented job benefits expired on September 6th. We expect headwinds to gradually fade, with labor demand remaining extraordinarily high. More than half, 62% of the country, has been fully vaccinated, still below the 70 to 85% threshold to return normalcy. Okay, so positive moves in high-frequency data for the United States, but not so much in some of the developing countries like Brazil or India, which probably are suffering a little bit more on the COVID front. In fact, let's actually take a look at that. Let's see here. COVID cases. India. No, actually, COVID's not doing horribly. No, it's not the low it used to have, but okay. And so maybe not correlated directly here to COVID. Yeah, not really either in Brazil. Seems like it's becoming much more manageable for folks. So that's very good. Yeah, we just want to be over COVID already. Okay, so right at that's weird. Right about 9 minutes here to the bell, we're getting the sharpest red candlestick, giving away some of the green push that we had here. Is this potentially the start of that selling into the close? Again, that's what my expectation was going into this, but expectations do not necessarily mean reality. What is reality, though, is getting up to $70 totally for free with Public. Just go to metkevin.com/public and get up to $70 totally for free. Check them out. They do not use payment for order flow, and they don't sell your information. You can also follow creators like me on there. I'm at Meet Kevin. And so when I post a trade on Public, you'll see that, which I've got some cash over at Public that I got to spend. So, all right, let's see here. Okay, let's write this down. There we go. So, watching the S&P 500 here, let's now take a peek at Financial Times for a moment. About 9 minutes to the closing bell, we have U.S. oil hitting a 7-year high after OPEC Plus resists calls to accelerate production. Let's see here. Hold on 1 second here. One sec. Okay. Yeah. Okay. Back we go. Electric vehicles. The revolution is finally here. Warren calls on the SEC to probe trading by the Federal Reserve. Yeah, this is always something that that frustrates individuals, and as it should, quite frankly. But you see stuff like folks at the Federal Reserve trading um, on on the eve essentially of Federal Reserve announcements. I think Clarito was one of them. It's not good. It's just not a good look. Not a good look at all. So we're gonna have to be careful of that. Let's see here. A firm getting shorted. Oh yeah, without a doubt. You're gonna see a firm get shorted here. I did not interview the CEO. I interviewed the CFO. Can you live stream getting your mail and waving to your neighbors with your yeah. So two members of the Fed resign. Exactly. Kind of sus. It's not good. Not good. All right. Let's see. Central banks differ on dispelling nightmare stagflation. Ooh. All right. What do we got here? Fight. Speaking. Well, let's check really quick. Okay. S&P 500 still stable. It's still stable. Look at that volume, though, folks. Look at that volume pressure. We saw these were the high bars right here. When we started rising, it was like, oh, are we going to get higher volume and increasing? That would be a sign to buy the dipping, right? Now we're getting high volume, and we did fall, but it's stable, which could also be a sign of buy the dipping. You always expect big volatility here until the last few minutes when you've got uncertain times. So we'll see if this volatility spikes even more or how this is going to play out. It is Monday. So we'll see. Woo! Gotta get that coffee flowing. It is a Monday coffee kind of time. All right, let's see. Let's go back over here. All right. Central banks almost everywhere face the same bad dream, a mix of slowing growth and inflation, supply shocks that together threaten stagflation. So far, they're confronting the problems in different ways. Yep. Interest rates have already risen in Norway and in many emerging economies, while the Fed and Bank of England move to tighten monetary policy. In contrast, the ECB, European Central Bank, and the Bank of Japan are sitting tight. No tightening yet here. But then again, Europe and Japan tend to have much slower growth than the United States. And developing countries or emerging economies certainly have more growth potential built into them than the United States, which does create more of a potential also for inflation, right? Like the last place I would really expect to see inflation run away is Japan, because they've just been facing a crazy deflationary curve, especially with population declines. And Europe's kind of been on the same page. Low growth, low inflation. I mean, the interest rates over there on real estate are like 1.2% or something like insanely low. I don't even know. Here, let me try this. Mortgage rates in here. Let's go to the financial capital, Frankfurt, Germany. Yeah. Okay. I don't know. Can somebody actually give me the German rates? That looks like it's September 24th. What do I care about September 24th? I want to know today. Give me the rate today. Look at that. Okay. So a 10-year fixed loan is 0.9% right now. A 20-year loan is 1.52 and a 30-year loan is 2.1. Come on, folks. That is like the definition of free money. My gosh, that's unbelievable. Anyway, I would love to just like get mortgages over there and like bring the money over here and buy stocks here. Different responses reflect the difficulty of dealing with what Harvard University's Megan Green calls every central banker's worst nightmare, a moment where global economic forces are both slowing and increasing inflation, slowing growth and increasing inflation. Look at the buy the dipping that's happening here, folks. We are not getting the sell. We are not getting that sell down towards the end of the day. We are getting dip buying here. That's also evidenced by, sure, our first high volume bar here of sells. We saw a fall, but then we had high volume continue here and we stabilized, sign to buy the dipping. And so it's no surprise that now you're getting some of that dip buying. This is good. I wonder if that'll be a signal for us that that the bottom has finally come, and we are here. We have arrived at the bottom because it's all pretty red right now. It's not pretty, actually. It's just red. Let's see here. Yeah, Dow Jones still down 1%, S&P 500 down 1.37, and NASDAQ down 2.22%. Continuing with the article here, the orthodox economic view is that central banks should do nothing to offset inflation caused by a supply shock, such as this week's rise in oil prices to a 7-year high. Responding to supply shock generated inflation with tighter monetary policy is extremely dangerous. And one of the reasons you see individuals say this is because you have a lag time in when interest rates actually affect the market. Whereas you could essentially say, oh my gosh, inflation's happening. Let's raise interest rates. You raise interest rates. The impact of raising rates doesn't hit the market for 6 months or the economy for 6 months. But then 6 months later, the supply issue is, let's say, gone and the inflationary pressures are gone. And now you just have slow growth. And now you're going to basically, pour water over a slow growth economy while it's not inflating, and you potentially push markets towards contraction or even the R word, recession. Anyway, central problem is that monetary policy typically works by raising or lowering economic demand. If spending is growing too fast and generating inflation, higher rates dampen the willingness of companies and households to consume. Same is not true when prices are rising because supply chains have been broken. Energy prices are increasing or there are labor shortages. In such cases, monetary policy is ill-suited for dealing with the shock, says this individual. Sometimes restrictive monetary policy has worked, like during the 70s oil shock, though Bundesbank action kept inflation from becoming ingrained in the economy. West Germany's central bank got things right. Then former ECB chief economist has written, because its tight monetary stance gave ubiquitous guidance to other economic decision makers, as well as the public, over a period of 3 years and kept a firm sense of direction. Yeah, I mean, look, if the market knows what's up, I always feel like that's the best case scenario. The last thing you want is uncertainty over what central banks are going to do, over what Jerome Powell is going to say. It's just like it always feels like you're chasing the cat's tail or chasing your own tail, going around and around in circles here. Good move. Look at that. We had we were wrong. The trend has ended. We just had this is a brand new trend. We have not seen this before yet, where we've actually hit bottoms, rotated up from there, and then rallied into the close on the highest volume, folks. This is good. Let's hit the bell. We have the Dow Jones down 0.93%, recovering slightly. S&P 500 down 1.29%, also recovering slightly. NASDAQ down 2.12%, also recovering slightly. And the Russell 2000 down 1.04%. Look at that insane volume bar of really just buy pressure that you had here in the last minute here. We thought volume was big over here, and apparently not. The real volume came in there right in the last minute today. It's incredible. That is incredible. All right, so we're going to pull off CNBC here, and let's see how things closed up. So look at some of the things here. How low. Outlet, for silly reasons, down 24%. Lordstown Motors down 10.41. Wish down 9.44. Ashford Hospitality down 9.06. Fastly down 8.75, along with Playboy, Metamaterials, Arrival, Affirm, 23andMe, CRISPR, Opendoor, EXPI, Ironnet, and Invitae, all down between 7.5% to 9.5%. Redfin down another 7%. Enphase down 6.66%, sitting at 145. Mind Medicine 221. Twitter down 5.86% today, along with Upwork at 5.81. Pinterest, Neo as well, 5.5% to the downside. Dropbox, Square, Wayfair, Zillow. I mean, there was very, very little protection you could have today in this market. It's crazy. Honestly, the best protection today was crypto. Crypto has done very, 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 very well, despite all this crazy fear. Yeah, and then you got Sheeb. Might do a video on Sheeb. We'll see. Volatility at 12.1234. Nice. Very good. Food company up 8%. Doge up. Cinemark up. Cinemark's up, but AMC kind of looks like it's being a little left behind. It's being forsaken. What's up with that? Yeah, AMC at 36.78. Let's go ahead and listen into CNBC for a moment.
I think broadly speaking, it is still intact. It's definitely undergoing one of the stiffer tests we've had in a while. I've been calling it really just a reset. And what's being reset? Well, expectations are being reset lower, both for earnings and really how relentless the market climb had been going into September. We've gotten the end of these streaks when we got the final kind of minus 5% close on the S&P after 11 months of not having that. It did sort of widen out the bands of what's going on. When the mega cap stocks start to get purged after weeks and weeks, when the average stock was kind of on the defensive and actually starting to bottom, that suggests that we're actually pretty far along into this process. If in fact there's not a lot of new macro stress or credit issues popping up, and there haven't been so far. So
that's what I believe as well, is that the no real stresses. It's just lingering crap regarding Congress and inflation and the other issues. Not something that's super concerning to me. More interested in getting that free stock with Public worth up to $70 when you go to metkevin.com/public. But yeah, otherwise, golly, I mean, relaxed. Really, I mean, no, very uneventful close. Let me put it that way. Very, very uneventful close. Was hoping for something a little bit more dramatic to really be able to take advantage of dip buys, but that's okay. I did a whole lot of buying today. I just didn't see another opportunity there after my earlier buys. Totally fine. That gives us more cash available for tomorrow and the next day and the next day and the next day. So super excited about that. Square, Zillow, Italia. Okay, good. So in terms of other news, though, it's relatively quiet. Let me quickly see if we have any earnings coming up. I doubt it, although we are at the beginning of an earnings season coming up, probably starting next week. Yeah, no, not really. Okay, let's see. Next week, usually you go to like a Tuesday or Wednesday. Yeah, see, next week you have JP Morgan, Delta, BlackRock, and I mean those are pretty big alone here. And I wonder if I can go on over to next week, Thursday, Taiwan Semiconductors, Bank of America, Wells Fargo, Citigroup, Morgan Stanley, Wells Fargo, Domino's, US Bancorp. Ooh, earnings season begins next week, and that'll come after the jobs data. Yeah, I mean, look at all the crazy things on the horizon. Jobs data this Friday. Next week, you have CPI data released on the 13th and earnings starting with bank earnings and travel earnings. Then you end up at the same time hitting that debt ceiling and infrastructure heights. Kind of makes sense why people want to sit on the sidelines a little bit. For me, no problem. Go ahead and sell me your shares. I'll buy the dip. So, yeah. Okay, good. Any other news here, folks? Little quiet on the news front here going into the end of the day. Warren asks SEC. Okay, we talked about that. SEC to investigate. China. Oh, what's this? Hold on a second. Let's take a look at this. Okay. Take a look at this one. Options market is signaling stock sell-off is approaching an end. Super awesome. I actually bought some calls today on a stock that had the lowest volatility that we've seen ever on the stock, which means it hasn't been on the market long, but it had some, over the last 6 months, some of the lowest volatility. So I'm excited about that and bought some call options on that one. We'll see how that goes. But take a look at this. Stocks are selling off, dragging the S&P 500 down more than 5% since its all-time high earlier last month. To its selling, one S&P 500 put contract that's 10% out of the money right now buys fewer equivalent call options than it did 3 months ago. The observation was made by RBC Capital as no guarantee that the worst is over, but it could be a sign that some options traders think so. So that's interesting. So in other words, if you sold a put, let's say you got a $10,000 credit, you could have used that to buy essentially the equivalent of 3 contracts about a month ago in terms of selling puts and call options. And that's now flipped. So call options have gotten more expensive, in other words. Derivatives traders have been, and that would imply that people are buying call options, right? Derivative traders have been preparing for this downturn since earlier this summer. piling into puts as the stock market ascended to new highs. So when the rut finally happened, yanking more than $2 trillion in the market value from the S&P 500, few were caught by surprise. Demand for protection may be elevated, but there are few signs of panic. That's an interesting line here. Demand for protection, like safety stocks, might be elevated, but a few signs of panic. Market was worried for a long time about, okay, well, just in general worried. Okay, got it. Less buying power. Got it. Rotation fears, but it's not the case for the entire stock market. While buying power of put contracts has fallen for the S&P 500 and small caps, it's moved in the opposite direction for tech companies. That's in line with the rut for NY FANG index that's down around 3% on Monday, teetering near correction territory with more than a 9% decline from its September high. Gotcha. Okay, so some comparisons. That's pretty much all they do is they sort of compare option contracts here, suggesting that the options market thinks that the end is near, which wouldn't that be absolutely wonderful? You get in, you do your dip buying, and then you sit around and watch. All right. But beyond that, relatively quiet in terms of news. So we're going to end this one a little bit early. Appreciate y'all being here. Thank you so very much. Get your free stock with Public by going to betkevin.com/public, and see you next one. Thanks again.